Welcome back to the Deep Dive. This is where we break down dense sources, like today's earnings call from American Eagle Outfitters, or AEO, and really just distill the key intelligence you need.
Yep, and today we are digging into AEO's Q3 results. That's for the period that ended back on November 1st, 2025.
And the big narrative here, it seems pretty clear.
Oh, it's turnaround, all turnaround. Management is pushing the story of a huge strategic pivot. We're talking about operational discipline, a new focus in merchandising, and some very, very expensive marketing.
And the market loved it. The response was immediate, right?
It was a really positive signal that investors are buying into this momentum story.
Okay, so let's get into why. The headline numbers, the big beat, that's what got everyone so excited right out of the gate.
It was a record third quarter, a decisive beat on pretty much every major metric you can look at.
So they pulled in, was it $1.36 billion in revenue?
$1.36 billion. That's a solid 6% increase year over year. And it comfortably beat the consensus, which was sitting around $1.32 billion.
But the profit story is where the real signal is, isn't it?
That's where you see the execution. Diluted EPS, earnings per share, landed at 53 cents.
53 cents. And the street was expecting something closer to 43 cents.
Exactly. That's a 23% beat. And maybe even more important, their operating income hit $113 million.
Which blew past their own guidance. I think their high end was $100 million.
It was. And when a company outperforms its own internal targets by that much, the market really sits up and listens.
So if we dig into that top line, the comparable sales, that's where the story gets really interesting.
It is. Total comps finally returned to positive territory at plus 4% after a pretty tough stretch.
But that number, that plus 4%, it's kind of hiding what's really going on under the hood, isn't it?
It absolutely is. It's a tale of two brands, really. And one is doing all of the heavy lifting.
You're talking about Aerie.
Aerie is on a tear. It posted double-digit comps at plus 11%. That is a true powerhouse. And you can see demand just accelerating through the quarter.
And meanwhile, the core American Eagle brand.
It posted a sequential improvement, which is good. It came in at plus 1%. So it's moving in the right direction. But, Aerie is the engine of this company right now.
Okay, so let's unpack that. How did they pull this off? How did they get the core AE brand moving in the right direction while Aerie just kept accelerating, especially in this tough retail environment?
Well, Aerie and Offline are clearly the company's big bet for the future.
No question.
Yeah, management said it over and over again. Demand for Aerie just accelerated from August right through October, and that momentum is carrying right into Q4.
And it's not just intimates anymore, is it?
Not at all. The growth is broad-based. It's across apparel, sleepwear, which has become this surprisingly powerful segment for them, and especially their Offline activewear brand.
The team sounds incredibly bullish on how much room they have to grow there. They kept pointing out that Aerie and Offline are still under $2 billion in revenue.
And hold less than 5% market share.
Less than 5% market share, even with that 11% comp growth. That's a huge runway.
It is. And it suggests they see this as a long-term structural growth story, not just some cyclical bounce. They think the brand has permission to just keep expanding, which explains where all the capital is going.
Okay, so let's shift to the core American Eagle brand. That plus 1% comp. It's not flashy, but it's a really meaningful step forward.
It is.
What specifically was driving that? What pulled that ship into positive waters?
It really came down to what they do best. Denim. They called it their key competency business, and it showed real strength. That, and they also saw better results coming from the men's category.
So a back-to-basics approach.
Exactly. Focusing on those high-margin core products where their quality really stands out.
But I remember reading they hit a bit of a wall early in the quarter, specifically with women's denim. Something about supply chain issues.
That's right. It's a good flag of an operational vulnerability, even with all the good news. They admitted they couldn't keep some of their best-selling women's jeans in stock early in Q3.
Just because demand was too strong.
Unexpectedly strong, yeah. They managed to fix those in-stock problems later in the quarter, and management's pretty clear that having that inventory in place is what's driving the positive trends we're seeing now in Q4.
So the lesson was to chase demand a little more aggressively.
Right. Don't be afraid to build inventory when something is clearly working.
Okay, and this leads us right into what might be the most fascinating and maybe the riskiest part of their strategy. The marketing spend. SG&A costs spiked 10% this quarter. That is a massive investment. So the big question is, was it worth it?
Well, management would tell you absolutely. They called it a strategic, high-conviction decision. That spike was all driven by a deliberate, really heavy investment in advertising to build the brand for the long term.
We're talking about those big campaigns, right? The Sydney Sweeney Great Jeans campaign.
And the Travis Kelce True Kolors collaboration. They claim those two campaigns generated over 44 billion impressions combined.
44 billion. That's an astronomical number. But impressions can be a vanity metric. How did that actually translate into sales?
That's the critical question, and they had an answer for it. They said the spend drove significant traffic, it boosted their digital engagement, and it brought in about 1 million new loyalty members.
Okay, 1 million new members is a real number.
It is, but the key piece of context they added was about the type of customer they're now targeting. It's a deliberate pivot to acquire more affluent shoppers.
Ah, so it's not just about getting more customers, it's about raising the lifetime value, the LTV of that new customer.
You've got it. They're essentially saying, we'll spend more upfront if it means we get a higher quality customer who spends more with us over time.
It's a bet that these campaigns are actually changing the brand perception and bringing in shoppers who might have overlooked AEO before.
It's a huge bet. If it works, the SG&A spike is a brilliant investment. If those new, more affluent customers don't stick around, well, it becomes very expensive vanity spending that could really hurt margins next year.
Okay, so now that we've covered the revenue side, let's look at the costs. What did the profitability picture look like, especially with all these different pressures?
And this is where the risk factor becomes very, very real. Gross margin actually dipped 40 basis points year over year. It landed at 40.5%.
And the main culprit there was tariffs.
The undisputed villain. Management confirmed a net tariff impact of $20 million in Q3 alone.
20 million. How much of a drag is that on the margin?
It was huge. That $20 million hit represented 150 basis points of drag on the gross margin.
Wait a second. If tariffs caused a 150 basis point drag, how on earth did the gross margin only dip by 40 basis points? They must have found massive savings somewhere else.
They did. And this is where their operational discipline just paid off in a huge way. They offset almost all of that tariff burden with two things: much lower freight costs and just exceptionally tight control on markdowns.
So they avoided the big promotional sales that a lot of other retailers got trapped in.
They did. They protected their margins, and they managed to leverage their buying and warehousing costs. It really helped them claw back most of what they lost to tariffs.
That's impressive for Q3, but let's talk about the future, because the tariff forecast looks a lot darker, doesn't it?
It is the single biggest threat they are facing. The Q4 guidance they just raised, it includes a massive warning. An expected incremental tariff cost of $50 million.
$50 million in one quarter. That's more than double the Q3 hit.
2.5 times. It implies they have some serious sourcing exposure, probably to goods made in China, and the rate structure is just accelerating against them. Mitigating a $50 million hit in 3 months is a monumental task.
But hold on, they're raising their Q4 operating income guidance to between $155 and $160 million, despite that $50 million hit.
I know.
That sounds incredibly aggressive. How can they be that confident?
It really comes down to two things. First, that insane acceleration they expect from Aerie with comps in the high teens. That top-line growth can absorb a lot of overhead.
And the second?
Management must be extremely confident they can squeeze even more costs out of things they can control. So even lower freight, even tighter promotions than we saw in Q3. It's a high-stakes operational bet that their discipline can outrun the geopolitical headwind.
Let's touch on inventory quickly. It ended Q3 up 11% in cost. Is that a red flag?
Management frames it as necessary and healthy. Remember those out-of-stock issues? They had to chase product for Aerie and AE denim. They say this increase is intentional. They need the inventory to meet that accelerated Q4 demand.
So they're investing to keep the shelves stocked, which should mean fewer markdowns later.
That's the idea. And you see that same focus in their capital allocation. They are actively remixing their entire store footprint.
Right. I saw their CapEx for the year is expected to be around $275 million.
And almost all of it is going toward profitable growth. The strategy is simple. Close about 35 low-productivity American Eagle stores, pruning the dead wood, and at the same time open a combined 48 new Aerie and offline locations this year.
They're physically tilting the whole company toward that Aerie growth engine.
That's exactly what they're doing. And it all connects back to that guidance raise. They're not just confident about Q4, they are making these long-term commitments, especially on that high marketing spend.
Yeah, that seems to be the new normal for them.
It is. They basically said that this elevated ad strategy is now a structural part of the business. They're resetting the annual spend baseline to around 5% of sales for the first half of 2026.
5% of sales. That's a huge commitment.
It is. They are intentionally taking the money they save from things like lower freight and plowing it directly into brand building. It's a commitment to a permanently more expensive way of acquiring customers.
But even with that massive commitment to advertising, they still expect SG&A to leverage in Q4. Can you break that down for the listener?
Sure. When we say SG&A will leverage, it just means that their revenue is expected to grow even faster than their expenses are. So even though the ad costs are going way up, the sheer force of Aerie's growth is expected to pull the top line up so fast that the operating structure actually becomes more efficient as a percentage of sales.
Which would completely justify the investment.
If they pull it off. If sales slow down, that leverage flips, and those high fixed costs become a huge problem.
And the market clearly believed they can do it. The stock closed up over 15% on huge volume after the call. But that central risk, that tariff headwind, it's not going away.
No, that is the pivotal question for AEO right now. Can their brand momentum and operational excellence overcome a massive trade policy headwind? It's a very high stakes, high conviction bet. And now for our segment, this is not financial advice. Just a reminder, this part of our deep dive is for illustrative and educational purposes only. You should always consult a licensed financial professional before making any investment decisions.
Absolutely. So with that very necessary disclaimer out of the way, let's talk about the market psychology here. The stock jumps 15%, which means the market is pricing in a successful turnaround.
It is. But the stock's implied volatility, which is just a measure of expected future price swings, spiked to near 79%.
Which means the options market is still pricing in a lot of uncertainty, even after the good news.
Exactly. That volatility is expensive. So our trade idea is designed to do two things. Capitalize on the structural growth of Aerie, but also sell that inflated post-earnings uncertainty.
Okay, lay out the idea for us. Try to keep it focused on the big picture bet.
So we're looking at a long-term option strategy. It's called a risk reversal. In simple terms, it's a two-part bet. Part one is bullish. We have high conviction in Aerie, so we buy a slightly out-of-the-money call option, betting the stock continues to go up.
Okay, that's the bet on continued growth. What's part two?
Part two is the belief that the turnaround has put a higher floor under the stock, so a huge collapse is less likely. With that belief, we sell a deeply out-of-the-money put option.
So you're expressing your bullish view by buying the call, but you're also selling downside protection that you think the market is overpricing.
Precisely. Selling that put helps pay for the call option, making the whole trade very low cost, and it banks on that high implied volatility coming back down to earth now that the earnings risk is gone. The whole thesis is that the market is still underestimating the long-term, durable growth coming from Aerie and offline.
That is a very specific directional bet. Okay, so to recap our deep dive today, the AEO Q3 beat was decisive. It was driven by Aerie's incredible strength and a very expensive, high-impact marketing push.
And all of that led to a robust guidance raise that the market loved, even with that massive tariff headwind looming on the horizon.
Which brings us to our final provocative thought for you to consider. Management is making a huge structural commitment by resetting their advertising baseline to 5% of sales for 2026.
So the question is this: will that high sustained investment translate into durable, structurally higher returns next year? Or will growth just normalize, and will they fail to get the leverage they need once the year-over-year comparisons from these big campaigns get tougher?
That is the strategic challenge they face. Join us next time as we take another deep dive into the numbers shaping the market.